It's a large, big opinion on NDTV Profit all through the last few days. This is as big as it gets. Sandeep Tandon, founder and CEO of Quant Mutual Fund, with us on the show to talk about his thoughts on the GST 2.0 and what it could mean. Sandeep, great having you as always. Thanks for taking the time out. Were you happy, Sandeep, when you saw the pace at which the reforms were brought out, and what most people say that while there were expectations built, the final print was actually better than what the expectations were? So are you happy as an investor, or would you have hoped for more?
Frankly speaking, Niraj, it is more than anybody's expectation. Okay, nobody has anticipated that government is willing to take such a big hit. Okay, because when we were more concerned about fiscal deficit, so nobody visualized this level of changes can. I think I will call it a very much revolutionary and much needed change. Government got a phenomenal opportunity to implement because rationalization thing has been talking about for last few years now, and I think it's a brilliant move from a longer term perspective. I'm not too much looking at from a very near term perspective because it takes time to stabilize. It takes time to have very near term challenges on the inventory side. But from a longer term perspective, a great news for India, and I think India could be one of the cheapest in terms of taxation on the food item is concerned. So long term, definitely a great move, and I think we will understand the real implications over a few quarters, not on immediate basis.
Um, Sandeep, hi, morning. Alex here. So I know that you've been traveling quite a bit to talk to people about your new offering, the SIF, and I'm guessing that you've had a chance to also get a sense of what is happening on the ground. Of course, in the previous quarter, you saw that GDP number that far exceeded expectations, but I'm wondering in your travels whether you've gotten any insight that tells you that things are better than they might seem on the surface.
I think the way I look at is that the ground realities are obviously right from July 2024 has slightly deteriorated, but it is coming back. So the base effect is also improved. There, the monsoon has been good, political stability has been very decent. And if you really look at the noise level, the tariff-related noise is actually a quite negative development for India. But the way government has handled the situation, the market has held very well, domestic institutions have used this opportunity to participate. I think net is a great development that we have ability to absorb such big shocks also. Okay, I'm using the word shock because it was not less than a shock, and we have absorbed it quite well. So that's the reason I think something has changed in India. I always talk about India. We are very constructive from longer term perspective because India remain buy-on-dip because we are in a structured bull run India, and a lot of things are changing from a longer term perspective. Maybe we have to live with one or two more quarters of pain because of the tariff related thing. But ultimately, Indian entrepreneurs are very sharp and very dynamic. They have absorbed these shocks in the past. And I think every crisis has been converted into opportunity. So I think I'm in that camp. This moment should be capitalized for building up exposure rather than giving up at this point of time.
Sandeep, so much of mixed views that why there isn't this kind of a response from investors despite the slew of announcements that have come in. GST has happened, rate cuts have happened. I mean, if there was a laundry list of what any investor would want from policy side, you could safely say that most of those boxes have been ticked. Where are the gray areas then, in your view? Where are the clouds in the sky?
See, we always talk about about from qualitative quantitative. There's a angle of behavior aspect. Okay. Now the sentiments aspect is obviously are affected right now. Last 1 year people have not made money, so is one psychological disturbance because the expectation for last many years has changed. The desired level. You are very happy with 12-15% sort of move in the past. Now if you talk about 12% return, people are slightly dissatisfied. Second most important aspect is that the environment then becomes slightly gloomy because you have to look at from FI's perspective. For them, it's not about absolute return game, it's a relative return game for them. When they are getting a better opportunity, they move out. And what is also obviously the some amount of macro picture deteriorated, which is government is taking efforts and started building up. And again, if something deteriorates, it takes few quarters to rebuild. So don't expect that within a week, 10 days time. But somebody asked me from 1 year perspective, somebody asked me from next 2 quarter perspective. I think we have seen the worst. And maybe earnings season also, maybe by the September quarter should bottom out. Even for the some of the company, technology company also, we talked about it showing signs of bottom. So I think the way I look at is that yes, sentiments are negative, and these are the moments when you not necessarily are playing a contra call, when we're looking at data-driven call. These are moments where you have to capitalize and build exposure rather than getting capitulated at the bottom of the cycle.
Sandeep, how are you feeling about internet companies? The reason I ask is because people either absolutely love them or they absolutely hate them. There seems to be very little middle ground. What camp are you in?
So the way I look at is that if you really look at when say India deteriorated in last 1 year, these companies were showing good signs of growth. Okay. Now obviously valuation wise they were expensive earlier also, they are even more expensive now. So the growth was driving these prices and that's the reason people were participating in these names. Now look at what has changed. Other sector, whether we talk about consumption related sector or large infra name, particularly the GST beneficiary, at least now you have a trigger. We are very clear that with these steps over period of next few quarters, it will translate into earnings. So now you have opportunity where something new sectors are coming up. They are already cheap, they are in neglected territory, and now you are getting potential growth triggers. And hence, logically, money will shift from these expensive, I will say, not necessary in a new age companies, which has done extremely well. For the same reason, when money got shifted towards new age, I think potential is there when the money will shift back from new age to the other consumption names.
Sandeep, I'm looking at your latest fact sheet, and it's come at a good time just before speaking to you. And you've spoken about the fact that you've decided to veer towards large caps and select mid and small caps. I'm wondering whether that is because of caution and you anticipate that there will be opportunities that present themselves in the broader markets, or do you think that the valuations are simply much more attractive in the large cap space?
So when you are in, let's say, in a difficult phase of the market, okay, for us at that moment, the liquidity is more important, okay. So rather than just looking at the pure return, because given the volatile environment which we have seen in 2025, the challenges which we have seen, which we have been talking about, it makes logical sense to have your portfolio relatively more liquid. It gives you psychological comfort rather than anything else. That's the first point. Second most important thing we have seen in right from July 2024, the impact cost on the Indian market has increased significantly. Now impact cost has again started declining, but it has come back to normally before what was there before to July 2024. The answer is big no. And that's the reason we still have skewed our portfolio relatively towards large cap purely from the liquidity and impact cost perspective. And obviously valuation they are thing, but that does not mean we are cautious or negative on mid and small. In fact, every forum we talk about, if you have that 5 year horizon, then small cap will give you the highest return. So one has to assess your investment horizon and individual risk appetite and accordingly look for selecting of the schemes. If somebody has that sort of appetite and has sort of horizon, then any mutual fund scheme on the mutual fund should be the good option.
Sandeep, just one final question from my end. I missed the book, right, that you write, because you predict for so long trends, etc. I wonder if...
A new one is about to release. One more book is coming very soon.
So I'm guessing we'll get the insights of that book once it releases. We should do a show on that, by the way. So therefore, I can't ask you about that, in which case I'll borrow a leaf from Alex and ask you. Alex told me that you guys have raised silver to 30% of your multi-asset fund. Is this also a sign of you being conservative and wanting to bank on broader assets which may be more stable as opposed to giving you gains?
No, Niraj, for last many months, I have been sounding some amount of caution in gold, and we said that gold around 3,500 could be a top sort of thing, okay? And we are not saying that a longer term top, but from a medium term perspective, and hence data points were showcasing that silver has potential to outperform gold from the current level. That's the thesis. We increased the exposure. We actually sold completely gold and entire precious metal space in our multi-asset fund is in the silver right now.
Okay. Okay, Sandeep, thank you so much for joining in today. Looking forward to talk to you soon on the book and more.
Yeah, thanks a lot.